Section 21. Understanding the financial implications. Don't default. The following week, Melissa met with a homeowner named Brian, who had finally decided to pursue a short sale after months of struggling to make his mortgage payments. As they reviewed the paperwork, Brian looked up and asked a question Melissa had heard many times before. "I understand how a short sale works," he said, "but financially, who actually loses? Is it just me?" Melissa smiled. "That's actually a great question." She invited Brian to join her and David later that afternoon so they could discuss not only how distress sales work, but also how they financially impact everyone involved. When Brian arrived, David welcomed him into the conference room. "One of the biggest misconceptions people have," David began, "is that a foreclosure or short sale only affects the homeowner." He paused. "In reality, these transactions affect everyone: the homeowner, the lender, junior lien holders, buyers, investors, and sometimes even the surrounding neighborhood." Brian nodded. "I never thought about it that way." David continued. "Understanding those financial consequences helps homeowners make better decisions and helps realtors properly educate their clients." He explained that from the homeowner's perspective, foreclosure is usually the most financially damaging outcome. When a lender completes a foreclosure, the event remains on the homeowner's credit report for years and generally results in a significant decline in the homeowner's credit score. The damage often makes obtaining future financing, qualifying for favorable interest rates, or even renting another home much more difficult. While every borrower's credit profile is different, foreclosure is widely recognized as one of the most serious negative credit events a consumer can experience. Melissa asked, "Does Arizona's anti-deficiency law prevent that credit damage?" David shook his head. "No." He explained that Arizona's anti-deficiency statutes, including ARS Section 33-814G and ARS Section 33-729, may protect qualifying homeowners from certain deficiency judgments after foreclosure, but they do not erase the foreclosure from the homeowner's credit history. Likewise, federal consumer protection laws, including the Fair Debt Collection Practices Act, regulate collection practices, but do not eliminate the financial impact a foreclosure has on a borrower's credit report. Brian looked surprised. "So even if I don't owe additional money, my credit is still affected?" "Exactly," David replied. "Legal protection and credit reporting are two different issues." Melissa then asked the next logical question. "So how is a short sale different financially?" David explained that although a short sale still negatively affects a homeowner's credit, it is generally viewed more favorably than a completed foreclosure because the homeowner voluntarily worked with the lender to resolve the debt. A short sale is commonly reported as a debt settled for less than the full amount owed, rather than as a completed foreclosure. While borrowers still experience a reduction in their credit score, the impact is often less severe, allowing many homeowners to recover financially sooner than if the property had proceeded through foreclosure. In many cases, borrowers may become eligible for future mortgage financing within several years following a successful short sale, depending upon the loan program and individual financial qualifications. Brian leaned back. "So even though neither option is ideal, a short sale may leave me in a better financial position." "That's often true," David answered, "but every homeowner's situation is different." Melissa then asked another question. "What about taxes?" David explained that one financial issue many homeowners overlook is the possibility of taxable income resulting from forgiven mortgage debt. If a lender forgives part of the loan balance during a short sale, the Internal Revenue Service may treat that forgiven amount as taxable income under federal law. Homeowners may receive a Form 1099-C reporting the forgiven debt. However, depending on the homeowner's circumstances, federal programs such as the Mortgage Forgiveness Debt Relief Act or insolvency provisions may provide important tax relief. Because these rules can be complicated and frequently change, realtors should always recommend that clients consult a qualified tax professional before completing a short sale. Brian asked another important question. "So if the lender forgives part of my loan, does that always mean I owe taxes?" David smiled. "That's exactly why realtors don't answer tax questions. We recognize the issue and refer clients to qualified professionals." Melissa then shifted the discussion toward deficiency balances. "What happens if the property sells for less than what's owed?" David explained that in a short sale, debt forgiveness depends entirely upon the lender's approval. Some lenders agree to fully release the borrower from additional liability, while others may require the homeowner to contribute funds or sign a promissory note before approving the transaction. Homeowners should never assume a deficiency has automatically been waived simply because the short sale closes. The lender's approval letter determines the borrower's remaining obligations. Brian nodded. "So the approval letter is just as important as the purchase contract?" "Exactly," David replied. "The purchase contract gets the transaction started. The lender's approval letter often determines how it ends." Melissa then asked about the lender's perspective. "Homeowners often think the bank always wins." David smiled. "That's another misconception." He explained that lenders frequently experience substantial financial losses during both short sales and foreclosures. When property values decline below the loan balance, the lender may recover far less than the amount originally loaned. If multiple liens exist, the first lender may absorb part of the loss, while junior lien holders may receive nothing at all. In addition, lenders often acquire foreclosed properties as real estate owned, REO, requiring additional expenses for maintenance, repairs, insurance, marketing, and resale before they can recover any remaining value. Melissa remembered another question she had recently received. What about private mortgage insurance? David explained that many borrowers who purchase a home with less than a 20% down payment are required to carry private mortgage insurance, commonly known as PMI. Although PMI does not protect the homeowner from foreclosure, it helps reduce the lender's financial losses when a borrower defaults and the property sells for less than the outstanding loan balance. This insurance reimburses the lender for a portion of the loss, helping reduce the lender's overall financial exposure after foreclosure or certain distressed sales. As the meeting concluded, Brian thanked both Melissa and David. When I first walked in, he said, I thought this was only about selling my house. David smiled. Today you've learned it's really about understanding the financial consequences of every decision. Melissa reflected on everything they had discussed. A successful realtor doesn't simply explain contracts or negotiate offers. They help clients understand the financial implications of their choices, recognize issues requiring legal or tax advice, and provide the education necessary for homeowners to make informed decisions during one of the most financially significant events of their lives. In the next section, we'll begin examining the financial documentation lenders require when evaluating a homeowner for a short sale, and why complete, accurate financial information is essential for lender approval. Online discussion. Discussion question 1. Why does a foreclosure generally have a greater financial impact on a homeowner than a short sale? Answer. A foreclosure generally causes greater damage to a homeowner's credit, remains on the credit report for a longer period, and may delay future financing opportunities more than a short sale. How do Arizona's anti-deficiency statutes protect qualifying homeowners, and what do they not protect against? Answer. Arizona's anti-deficiency statutes may protect qualifying homeowners from certain deficiency judgments after foreclosure, but they do not prevent the foreclosure from appearing on the homeowner's credit report or eliminate the resulting credit damage. Discussion question 3. Why should realtors encourage homeowners to consult tax professionals during a short sale? Answer. Forgiven mortgage debt may have federal income tax consequences, depending on the homeowner's circumstances. Realtors should recognize these issues, but refer clients to qualified tax professionals for advice.